Next Vault presents, what if billionaires suddenly disappeared? No Jeff Bezos, no Elon Musk, no mega fortunes zooming around the planet. Would the world be fairer or poorer? Today, we'll explore the economic, political, and social consequences of a world without billionaires, using the latest research and reporting to separate fantasy from likely reality. What no billionaires could mean. First, what do we mean by no billionaires? There are different ways to get there. Extreme ones like forcibly seizing wealth and redistributing it, or more plausible policy paths like a high progressive wealth tax, steep inheritance taxes, or strict limits on corporate concentration that prevent fortunes from accumulating in the first place. Each approach has very different practical and legal implications. The upside: inequality, public spending, and political power. Advocates say the gains could be huge. Reports show billionaire wealth has exploded in recent years, and a small slice of those fortunes could fund many public needs. For example, Oxfam estimates the world's billionaires collectively grew their fortunes by trillions in the last decade. Wealth that, if taxed differently, could finance healthcare, education, and climate action. Reducing billionaire wealth could also blunt the outsized political influence that extreme wealth often buys. Practical impacts: a one-time or permanent tax on ultra-wealthy holdings could raise tens or even hundreds of billions annually, money that could be targeted to reduce inequality or strengthen public goods. Proponents also argue fewer billionaires means fewer incentives for rent-seeking, monopoly rents, and political lobbying. The counterpoint: entrepreneurship, investment, and growth. But there's another side. Some academic work finds that a subset of extremely wealthy founders, people who became rich by creating new technologies and firms, have spurred innovation and economic growth. Removing or dramatically taxing these fortunes risks discouraging the risk-taking and long-term investment that helped create those innovations in the first place. Evidence on the growth effect of inequality is mixed and depends on how wealth was created, whether by innovation or political privilege. There's also a real practical problem: capital is mobile. Studies show wealthy people respond to tax incentives. Some move jurisdictions or change residency to reduce their tax bills. Countries that tried big wealth taxes have seen capital flight or tax avoidance unless rules are internationally coordinated. That makes unilateral elimination of billionaires politically and practically difficult. Philanthropy: helpful or a substitute for public policy? Billionaire philanthropy is often presented as a public good, funding research, schools, and cultural institutions. But critics note that private giving is neither democratically allocated nor necessarily aligned with public priorities. In addition, charitable giving can produce tax subsidies that effectively transfer public revenues into private control of social agendas. So eliminating billionaires would remove many philanthropic dollars, but it would also remove the power imbalance that lets a few donors set public priorities. What would actually happen day to day? Practical scenarios. Let's play out a few realistic scenarios. Scenario A: heavy wealth taxation and redistribution. Governments implement a high annual wealth tax on fortunes above a threshold, plus tighter inheritance rules. Over years, this compresses top wealth and funds public services. This is politically feasible only with international coordination to limit flight and avoidance. Evidence from countries with long-running wealth taxes shows mixed results. Revenue can be meaningful, but enforcement and capital mobility are big challenges. Scenario B: legal prohibition on billionaire-level ownership. This would require seizure or forced redistribution. It could raise massive one-off funds for public use, but also destroy investor confidence, collapse stock markets tied to founder-led firms, and trigger long legal battles. Academic modeling warns growth could slow, hurting poorer nations most. Munich Personal Repack Archive. Scenario C: structural reforms, anti-monopoly, worker power, higher corporate taxes. These steps don't wipe out extreme wealth overnight, but reduce the chance of dynastic fortunes forming. Many economists argue these reforms are the least risky path to lower inequality without killing growth. Political feasibility and recent moves in the world, politics matters. We're already seeing discussion and action. Proposals for minimum taxes on the ultra-rich and wealth levies have appeared in multiple countries. Norway's debates and the recent public campaigns in Spain, Brazil and others show appetite for change, but also show how powerful pushback can be from wealth holders. International coordination and robust legal design are essential. So, what's the bottom line? If no billionaires means a fairer, better funded public sector and less concentrated political power, there are clear potential gains. But if it's done clumsily, through expropriation or without global coordination, it risks capital flight, slower growth, and unintended damage to innovation. The sober answer: policy that reduces extreme wealth via taxes, anti-monopoly rules, and stronger democratic institutions is likely a more practical and less destructive route than trying to erase billionaires overnight. If you liked this breakdown, drop a comment. Which scenario do you think is most realistic? And if you want a follow-up, I can build an episode focused on how a global wealth tax could actually be designed step by step.